For millions of investors, I mean, right across the United States, the road to retirement isn't paved with these deliberate, thoughtful choices, is it?
No, not at all. It's something much simpler.
It's a simple silent default. We're talking about the target date fund, or TDF.
Yeah.
If you've ever signed up for a 401k or a similar plan and, just didn't get around to choosing your investments, you were almost certainly put into one of these.
That's the default.
But here's the crucial, frankly unsettling realization we need to dive into today. That default choice, the one that's supposed to be the safe path for your life savings, might actually be actively jeopardizing your entire retirement.
And the stakes here they're just massive. I think they're often dangerously underestimated by the plan participants themselves.
How massive are we talking?
Well, we are exploring an investment vehicle, the target date fund, that now holds a staggering total of over $4 trillion in assets.
4 trillion.
And here's the really critical timing issue. We have about 75 million baby boomers now firmly in what the industry calls the retirement risk zone. The problem isn't just about, disappointing returns. It's about this hidden excessive risk that most of these TDFs are engineered to maintain precisely when participants need protection the most.
And these are the people who defaulted him, thinking they were safe.
Exactly. They operate under this profound and dangerous misconception. They genuinely believe their investments are becoming safer, managed, protected as they get closer to retirement. But our source material today reveals that the industry standard is to be anything but safe.
Okay, so let's unpack all of this. Our deep dive today is custom tailored to help you understand the structural flaws in this one-size-fits-all TDF model.
We're going to get into it.
We're going to dissect how the industry's reliance on a set-it-and-forget-it mindset really limits the engagement you need and, most critically, exposes investors to unprecedented vulnerability right when their account balances are at their highest.
We have to understand why the next market correction poses such an existential threat.
And just as important, how personalized solutions, like one called Soteria, are stepping up. They're setting a completely new and vital standard for what we must now demand: substantive prudence in retirement investing. So let's jump right into the core danger here. We need to talk about the risk zone. This isn't just financial jargon. It feels like a clinical term for a period of, extreme vulnerability.
It is.
What exactly defines this period, and why is a market crash during this specific window so uniquely devastating?
The risk zone is, it's clinically defined as that crucial period spanning roughly 5 to 10 years immediately before you retire, and then another 5 to 10 years right after.
Why, so a decade or two, centered right on that retirement date.
We consider it the danger zone because losses you sustain here are amplified by a concept known as sequence of return risk. This is the risk that you get a string of poor investment returns right at the beginning of your withdrawal phase, or just before it.
And the timing of those poor returns makes all the difference, right? A 30% drop when you're 30, you've got decades to recover. But a 30% drop when you're 65?
Precisely. That's a completely different universe.
Yeah.
If you sustain substantial losses during this 10 to 20-year risk zone window, it can irreparably ruin the remainder of your planned financial life.
And why is it so devastating then?
It's compounded by two powerful factors. First, your account balances are typically at their absolute highest level right as you transition into retirement.
Makes sense.
So even a small percentage loss is the largest dollar loss you will ever sustain in your life. Second, and this is really the financial cliff, your ability to replenish that lost capital with labor income, with paychecks, is either severely diminished or it's completely gone.
You can't just earn it back.
You can't. That timing and that amplification of loss is the essence of sequence of return risk.
That leverage point is what makes it so brutal. I mean, a 30% drop forces you to sell assets at a depressed price just to get the income you need to live, which locks in those losses forever.
You can't participate in the recovery.
And we don't have to guess about this. We have a very recent and profoundly sobering case study from the 2008 financial crisis.
Indeed. And the 2008 crash offers a stark lesson that, frankly, appears to have been largely ignored by the major fund providers. Back then, the TDF industry was pretty new, holding only about $200 billion in assets.
A fraction of today.
A tiny fraction. But funds targeting retirement around 2010, meaning the participants were squarely in that critical pre-retirement risk zone, they were invested far, far too aggressively. The data shows the typical 2010 fund lost more than 30%.
30%. On a lifetime of savings right before you plan to stop working, that level of shock must have just prompted panic. panic withdrawals.
It did. And the lasting impact of that loss is where the sequence of return risk really bites. Because of the timing, because of the lack of confidence, reports show that most of those TDF participants just withdrew. They cashed out the remaining savings at retirement.
They ran for the exits.
Understandably, they were seeking immediate safety. But critically, because they exited the market, they did not benefit from the subsequent 13 years of strong market recovery that followed. They locked in the losses permanently.
Let's quantify that failure. Can you contrast what the typical fund did with a more protective model? This is where the numbers become, profoundly human.
Absolutely. So let's compare the typical 2010 TDF participant. They had an aggressive allocation, about 55% in stocks. They lost 30%, and then they cashed out.
Okay.
Based on standard financial modeling, that person was left with enough capital to fund maybe 7 years of spending.
7 years.
Now, contrast that with an example using the patented Safe Landing Glide Path, or SLGP. This was designed specifically to be much safer near retirement, targeting only about 10% equity exposure.
A huge difference.
Huge. That path, subjected to the exact same 2008 crash, lost only about 4%. The participant following that safer path would have been left with enough capital to fund about 18 years of spending.
Wait. Say that again. 7 years versus 18 years of financial freeze.
That's the difference.
That difference, 11 years of solvent retirement, is the direct, measurable cost of that excessive risk. That's not a rounding error. That's the difference between poverty and dignity in old age.
It is the cost of a structural failure. And now, as we said, the situation is geometrically worse. The TDF industry is a $4 trillion behemoth, and 75 million baby boomers are passing through that perilous risk zone as we speak.
So the next correction...
The next market correction, whenever it arrives, will be substantially more devastating for these participants than 2008 was, simply because of the sheer volume of unprotected assets.
Let's scrutinize that current risk profile then. We're talking about an oligopoly here, right? It's dominated by the biggest names in finance.
It is.
So what is the standard practice of Vanguard, TIAA, Fidelity? Together they manage something like 2/3 of that $4 trillion.
The standard practice is dangerously consistent. The entire industry, which you can see reflected in benchmarks like the S&P TDF index, mandates that these funds enter retirement at dangerously high risk. The typical allocation at your target retirement date is about 50% in equities.
50% stocks on the day you retire.
Plus, another 40% allocated to long-term bonds.
So 90% of the portfolio is in what the industry considers risk assets. That sounds incredibly high for someone who plans to quit their job next week.
It translates to approximately 85% risky assets at the target date when you really look at the asset types. And this high-risk strategy is expected, based on historical analysis, to experience excessive losses. We'll define that as a loss greater than 10% in 3 out of every 20 years.
A 15% chance of a major loss right at retirement.
For a plan sponsor, maybe 3 out of 20 sounds like acceptable odds. But for you, for an individual who only gets to pass through the risk zone once in your life, those odds are simply unacceptable. It's a 15% chance of severe financial calamity.
We absolutely have to dispel the bond illusion here because that 40% in bonds is what people think makes it safe. They hear 50% stocks, 50% bonds, and think balanced and safe.
Right. It sounds prudent.
But you're telling us that the long-term bonds in these funds are a massive part of that 85% risky asset calculation. How can a bond be a risky asset?
Well, the notion that all bonds equal safety is just fundamentally incorrect, especially when you're talking about long-term, high-duration debt. We have to distinguish.
Okay.
Assets that are truly safe and protective are short-term treasury bills, or maybe TIPS, Treasury inflation-protected securities. These have low short-term volatility and give you crucial inflation protection. The moment you introduce long-term bonds, however, you introduce significant duration risk.
Also known as interest rate risk.
Exactly, duration risk. The sensitivity of the bond's price to changes in interest rates.
So how does that translate to real-world volatility for someone in the risk zone?
Think about it this way. When you invest in a long-term bond, you're buying a fixed stream of payments for 10, 20, or even 30 years. If interest rates rise, as they've done sharply in recent years, that fixed rate you bought becomes much less attractive.
Right, because new bonds pay more.
Exactly. Yeah. So the discounted present value of your original bonds payments falls dramatically. The price of that bond drops. And the longer the duration, the bigger the price drop for any given increase in rates.
So if I'm 65 in a TDF and 40% of my money is in these long-term bonds, those bonds can fall 10%, 15% or more just because the Fed raises rates. It doesn't even take a stock market crash to wipe out a chunk of my savings.
Precisely. You don't need a stock market crash, you just need an interest rate shock, which is a
Mm.
common feature of the economic cycle. We saw this acutely with the Silicon Valley Bank failure. They were
Yes.
holding a massive amount of 10-year treasuries, things that are traditionally seen as the gold standard of safety. But when rates shot up, the discounted value of those assets plummeted, causing huge unrealized losses.
It broke the bank.
It demonstrates that interest rate increases transform even medium-term bonds into highly volatile and risky assets. Yet, the TDF industry relies on these long-term risky bonds for a perceived stability, because they tend to correlate differently than stocks.
Mhm.
In the risk zone, though, they offer very little real protection.
So we've established this massive problem. Default funds are the standard, yet they expose millions of people to this, existential sequence of return risk at the worst possible time.
It appears to be a systemic failure.
It does. It feels like it's prioritizing institutional convenience over the best outcome for the actual person. So why has this risky default been allowed to persist as the standard practice for so long?
The persistence, it really stems from a fundamental conflict in how fiduciaries approach their duty. It's conflict between what we call procedural prudence and substantive prudence.
Okay, let's define those terms, because they sound crucial not just for understanding the history, but for the legal landscape going forward.
Absolutely.
Yeah.
So procedural prudence is essentially the act of following the industry crowd. If a plan sponsor or an advisor just selects a target date fund from one of the big reputable firms, Vanguard, T. Rowe Price, Fidelity, they're ensuring they're not alone.
It's safety in numbers.
Exactly.
Yeah.
If the fund blows up, they can argue, well, we followed standard industry practice. We used the biggest names. They are procedurally safe from an immediate legal challenge. And this approach was really reinforced by the Pension Protection Act of 2006, the PPA.
What did that do?
It legally blessed TDFs as qualified default investment alternatives, or QDIAs. This gave plan sponsors a powerful safe harbor, which incentivized that institutional convenience, the ease of picking an established provider over any rigorous analysis of participant safety.
So the PPA basically created a regulatory path of least resistance, which led to this mess. And that leads directly to the demand for what you called substantive prudence.
Precisely. Substantive prudence is the superior standard. It requires doing what is actually best and right for the investor, focusing on the participant's specific situation and needs, regardless of what the crowd is doing. The shift to substantive prudence is essential because the current TDF design is locked into that set-it-and-forget-it model based almost entirely on the lower standard of procedural prudence.
That structural failure brings us right to the flawed method of risk measurement. If procedural prudence is the guide, how do traditional TDFs define risk, and why is that definition so inadequate for an individual investor?
Traditional TDFs use a purely objective metric called risk capacity. It's a very simplistic function of just your age and your accumulated wealth. It assumes that every single person retiring in the year 2045 has the exact same tolerance for market volatility just because they share a retirement date.
Which is absurd. People are not interchangeable calendar entries. Two 60-year-olds could have vastly different situations: pensions, real estate, psychological profiles.
It absolutely must shift toward risk tolerance. Risk tolerance accounts for an individual's personal, subjective, emotional comfort with risk. What genuinely lets you sleep at night. This is the only way to get individual differentiation, which is the cornerstone of good advice. It allows for conservative, moderate, or aggressive paths.
And it's not just about comfort, it's about redefining risk itself for retirement, isn't it?
Yes. Risk shouldn't be narrowly defined as short-term market volatility, which is what standard deviation measures. For your retirement, risk should be defined as the likelihood of failing to build enough savings to fund your spending throughout your entire retirement. That savings shortfall risk and the ultimate threat, longevity risk.
So to understand why the industry landed on this simplistic ad hoc design, we have to look back at the academic foundations. It's not that the science didn't exist, it's that the implementation was just too difficult, right?
The theory is incredibly robust, dating back to foundational figures. We start with Harry Markowitz's static portfolio theory in 1952, which was then extended into these dynamic programming models by Paul Samuelson and Robert Merton in 1969. Their work was revolutionary, focusing on how optimal portfolio decisions should evolve over a person's entire life.
And what did those early models suggest about how your asset allocation should change as you age? Because the common wisdom is stocks should just drop dramatically.
Their initial findings, based on some very specific assumptions, were actually kind of counterintuitive. They suggested the share of risky financial assets should remain relatively constant throughout your life.
Constant. How does that work?
It only makes sense if you consider your total balance sheet, not just your 401k. The key component that offsets this is human capital, the present value of all your future paychecks.
Ah, so your ability to earn a wage is treated like a massive low-risk bond asset.
Correct. When you are young, your human capital is enormous, and it acts like a big, low-risk bond in your total lifetime portfolio. As you age, that human capital bond decreases. To keep the overall balance of your total wealth constant, the standard Merton-Samuelson model suggested that your risky financial assets should maintain a fixed proportion.
But we know that's not really how it works in the real world. As you get closer to retirement, your job might be less secure, your health can decline, your ability to absorb risk is just lower. If the theory was so complex, why did the practical application turn out so, well, simplistic and risky?
This is where we run straight into what academics call a curse of dimensionality.
Okay.
The elegant dynamic programming models required to solve these problems, how much to save, how to invest across time, they become computationally impractical when you introduce real-world complexity. You need to factor in not just age and savings, but uncertain income, uncertain inflation, transaction costs, multiple asset classes, risk tolerance.
So adding more real-life variables makes the math exponentially harder.
Exactly. And because the computer models of the 70s and 80s just couldn't handle that complexity for a personalized solution, fund managers, basically,
They punted.
they took a shortcut.
Precisely. The practical necessity of simplicity led them to resort to these ad hoc, one-size-fits-all glide paths that bear very little resemblance to the academic optimum for any specific person. They chose institutional simplicity procedural prudence over individual optimization. And that explains why we ended up with the dangerously slow, high-risk glide paths we have today.
So if the industry standard is based on these compromised ad hoc models born from old computational limits, the academic community must have proposed better solutions. What is the scientifically recognized alternative that actually mandates safety at retirement?
The alternative is built around the safe landing glide path concept, the SLGP. The fundamental philosophy here is a radical recognition. Because you only pass through the risk zone once, your objective has to shift from maximizing accumulation to ruthlessly maximizing the preservation of your capital.
You stop playing offense and start playing defense. It's simply deemed a bad gamble to risk a lifetime of savings near retirement. The potential upside just does not compensate for the devastating permanent downside of loss.
Which means applying the brakes much earlier and much more aggressively than current TDFs, which, as you said, keep 50% in stocks right at the target date.
Exactly. The SLGP is engineered to be very safe at its target date to protect against that sequence of return risk. And this requires designers to make two key decisions. First, when to start applying the brakes, usually a decade or more before retirement. And second, how forcefully to apply them. Meaning you increase the protective assets, like short-term T-bills and TPS, at an increasingly accelerated rate, ultimately aiming to reach or get very close to 100% safety right at your target date.
But wait, if this model takes you down to near zero stocks right at retirement, aren't you guaranteeing the investor will miss out on the growth they might need, especially if they haven't saved enough? Isn't that a failure of fiduciary duty in itself?
That is the critical caution. It really speaks to the necessary philosophical shift. We have to acknowledge that models focused only on maximizing your final account balance often suggest you should maintain or even increase equity exposure.
But those are just averages from simulations.
Yes, averages over thousands of simulated lives. The SLGP focuses on the undeniable human reality. We only get one life. The trade-off between maximizing a potential slightly higher final number and guaranteeing stability when it matters most is not a close call.
The emotional toll of a crash is huge.
Disruptions to your planned retirement cause immense emotional and physical tolls, depression, health calamities. If you have a savings shortfall, the answer is to save more, not to take a catastrophic gamble in the risk zone. Safety near retirement makes an enormous, irreversible difference to your planned lifestyle.
This safety-first, preservation-focused approach leads us directly to the U-shaped glide path. That's the logical conclusion of this framework. Tell us how that dynamic structure works over an investor's entire life.
The U-shaped philosophy aligns strongly with research, particularly from Dr. Wade Pfau and Michael Kitz's. This framework mandates a radical departure. It says an investor should have high equity early on, that's the left side of the U, but should enter retirement with very low risk.
How low?
For example, with only 10% equity exposure. That provides maximum protection against that early sequence of return risk.
So we have the bottom of the U right at the retirement date where maximum protection is. What happens after that date?
Once the initial danger of the first few years of the risk zone is passed, the period where early losses are most devastating, the investor can begin to gradually re-risk their portfolio. That's the right side of the U.
You slowly add risk back in.
Yes. This gradual increase might see equity exposure rise back toward 45% or 50% over the next 10 to 15 years. The low initial risk protects the maximum account balance, while the later re-risking helps extend the life of the assets, combat inflation, and address longevity risk.
That makes perfect sense. You front load the safety when your balance is highest and most vulnerable, and then you gradually reintroduce growth to make sure your money lasts.
Exactly. But here is the critical limitation for the existing industry. The U-shaped path requires the portfolio to achieve substantive safety at the target date. The typical TDFs cannot adopt this path because it's already dangerously risky. 50% equity, 40% long-term bonds at the target date.
They're starting from too high a point to re-risk.
Precisely. Their volatility would be extreme. The U-shaped framework is designed to serve for a lifetime, functioning as a true through fund.
And we've established that this need for a dynamic, personalized approach is a global concern, not just a U.S. regulatory failure. How is this impacting policy elsewhere, particularly in developing pension systems?
The global shifts really underscore the recognition that these static, high-risk models are failing. We can look at two prominent Latin American examples, Chile and Mexico.
Let's start with Chile. They seem to be undergoing a pretty major structural shift right now.
They are. Chile is transitioning away from its traditional multi-fund structure, where people were often just arbitrarily moved between 5 static risk funds, to a true target date framework. In 2025, Chile introduced TDFs, which they call Fondos Generacionales, as the default option.
So they're embracing the glide path concept.
Yes, and the regulator is tasked with defining a dynamic glide path that explicitly incorporates total accumulated wealth and investor risk tolerance. This regulatory mandate is a massive step toward personalization and substantive prudence.
And what about Mexico? They transitioned a bit earlier, didn't they?
Mexico transitioned its retirement system to what they call generational C4s in 2019. Their system uses sophisticated risk-based limits like value at risk, or VAR, to enforce a unified glide path. However, despite this sophistication, the portfolios are remarkably conservative compared to U.S. TDFs.
How so?
For example, the equity cap for their youngest participants is only 60%. While caution is prudent, critics argue this might be excessively conservative, potentially failing to generate enough long-term returns.
So while the U.S. problem is too much risk, the Mexican problem might be too little growth. But both examples show that regulators are struggling to find the optimal path.
Exactly. The Mexican regulatory focus on short-term risk metrics highlights a gap. They are achieving regulatory compliance against volatility, but maybe at the expense of long-term retirement adequacy. These international examples just underscore the complexity and illustrate that the U.S. problem of regulatory inertia allowing excessive risk through that QDIA safe harbor is a serious divergence from the global trend.
So the theory is crystal clear. We need to move from the dangerously rigid industry standard toward true protective personalization, especially in that critical transition into retirement. This is where Soteria comes in, named appropriately for the Greek goddess of deliverance from harm.
A very fitting name.
How does this solution bridge the gap between that academic prudence, the safe landing framework, and the messy reality of the market?
Soteria is a software solution designed precisely to operationalize that deliverance from harm by correcting the deficiencies of standard TDFs. It takes the academic breakthroughs, the life cycle theory, the U-shape, the emphasis on preservation, and transforms them into a practical, implementable structure.
For individuals in plans and managing their own IRAs.
For both.
How does Soteria achieve that necessary personalization, moving beyond that flawed metric of just risk capacity?
It integrates sophisticated human capital theory with personalized risk tolerance. Unlike traditional TDFs stuck on the simple metric of age, Soteria allows risk levels to dynamically adjust based on both your age and your personal emotional comfort level. It uses the patented safe landing glide pathy framework to create not one, but a suite of customized glide paths.
So conservative, moderate, and aggressive versions.
Exactly. And all of them are designed to protect assets by rigorously minimizing risk right at that target date.
This sounds like a revolutionary tool for financial advisors who serve retirement plans. How does Soteria help a plan sponsor move from that procedural prudence to substantive prudence and still offer a compliant default, a QDIA,
For advisors to retirement plans, Soteria provides a breakthrough QDIA. It allows plan sponsors to offer a master customized TDF QDIA. This is crucial because it immediately corrects the core one-size-fits-all flaw.
They're not stuck with the risky off-the-shelf option.
No. Instead of being forced to choose one dangerously risky fund from the oligopoly, the plan can offer a full suite of personalized glide paths, giving the plan control over the precise risk levels. This is a massive, legally defensible step towards substantive prudence. The plan takes control of the risk design.
Okay, that covers the plan side. But what about advisors who work with individual investors, maybe managing their IRAs or advising them on their existing 401ks?
This is where Soteria utilizes the powerful separation principle. This principle, which is foundational to modern portfolio theory, dictates that the decision of what allocation structure to hold the glide path should be completely separated from the decision of which specific assets to buy.
So Soteria provides the scientific blueprint, the glide path, and the advisor provides the customized portfolio to fill it.
Exactly. Soteria provides the optimal structural investment model, the scientific path based on the client's age, time horizon, and crucially, their personal risk tolerance. The advisor then implements that U-shaped structure using their preferred funds or brokerage platforms.
So they can bring this safer path to all their clients.
It allows advisors to bring the science of safer lifetime investing paths to all their individual clients and serve them holistically, applying the same high standard across their company plans, their IRAs, and any other accounts.
That structural personalization must also support better investor behavior, which we know is often the single biggest factor in long-term success.
The control and personalization are critical for behavioral finance. Participants aren't locked into a single, rigid path designed for some average person. They gain personal control over their unique life paths. They can manage their risk by moving at will among the low, middle, and high-risk options along those U-shaped glide paths.
So if life changes, they can adjust.
Yes, that ability to adjust their risk exposure is vital. When a health concern comes up, a new savings goal, a different risk tolerance after a market shock, they need the flexibility to immediately adjust their glide path to match their new reality.
The push to embrace these substantively prudent models like Soteria isn't just about better outcomes, it's about the escalating legal reality of fiduciary responsibility, particularly under ERISA. If TDFs are exposing millions to excessive risk, that sounds like a massive legal ticking time bomb.
It absolutely is. We've seen the groundwork being laid by the plaintiff's bar. Law firms have successfully sued BlackRock and others over underperformance, arguing that even if the manager was just matching the market, the fiduciary choice of the underlying risky assets was imprudent.
So the same logic would apply here.
When the next major market crash hits, exposing that $4 trillion parked in high-risk TDFs, the plans that chose those standard aggressive TDFs will face massive lawsuits for substantive imprudence. The fiduciary liability of employers extends directly to that core investment choice.
And the scope of this fiduciary duty is always expanding, which is highlighted by this truly fascinating and frankly terrifying recent lawsuit about operational security and cyber theft.
This case is a critical warning to all fiduciaries. It demonstrates that their duty covers not just investment strategy, but operational security. We are referring to the Bartnett v. Abbott Laboratories et al. Lawsuit from 2020. This involved the theft of $245,000 from a participant's account.
Okay, so let's walk through the mechanics. How did a cyber thief manage to drain nearly $250,000 from what should have been a secure retirement account?
The mechanism was disturbingly low-tech. First, the plaintiff's personal email account was compromised. The thief then went to the plan's website, which was run by the Recordkeeper, Alight Solutions, and used the forgot password option.
And the code went to the hacked email. Exactly.
So the thief gained full access to the plan account. They changed the password and, critically, added a new unassociated external bank account, a SunTrust account, as a distribution option. Alight, following its standard 7-day waiting period, then authorized the transfer of the entire $245,000.
So who did the court find legally responsible? Where was the line drawn on fiduciary status under ERISA?
The court made some very sharp, instructive distinctions. The claims against the plan sponsor, Abbott Labs, were dismissed because the plaintiff failed to allege any specific fiduciary acts linked directly to the theft.
What about the plan administrator?
Claims against the administrator were also dismissed. The court couldn't infer the administrator was responsible for the website's security, as Alight maintained the site. And critically, regarding the duty of prudence, the court said this duty wasn't found to cover preventing such cyber theft if the risk was not known.
It seems like a narrow escape for the planned fiduciaries. But the record keeper, Alight, didn't escape liability.
No, the claims against Alight were allowed to move forward. Alight argued, as they always do, that it was just performing ministerial functions, simple administrative tasks, and so it wasn't a fiduciary. The court disagreed strongly.
Why?
The complaint successfully argued that Alight's actions, specifically exercising discretionary control over plan assets by dispersing the $245,000, were enough to infer that Alight was acting as a functional fiduciary.
That is a massive legal departure. It suggests that standard record keeper functions, like authorizing distributions, can now trigger full fiduciary status and liability.
It's hugely significant. This case represents a growing trend where plaintiffs are surviving motions to dismiss by alleging that service providers become functional fiduciaries for failing to prevent cyber fraud. The court even sustained a claim against Alight under the Illinois Consumer Fraud Act for failing to protect Bartnett's personal information.
This really brings us full circle, doesn't it? Whether the risk is a market crash or a cyber breach, fiduciaries face evolving, heightened legal standards of prudence.
That is the definitive connection. The Bartnett case highlights that the duty of prudence under ERISA has to evolve to meet modern threats, extending to the operational management of the plan. This directly mirrors the investment risk issue.
It's the same principle.
If the liability for operational lapses, like weak cyber protection, is increasing, then the liability for flawed core investment choices, like excessively risky TDFs, will face even higher scrutiny. When the next market correction hits, the argument will be clear. Why did the fiduciaries expose participants to massive sequence of return risk when substantively prudent, scientifically validated, safer alternatives were readily available? So we've established definitively that the standard default TDF is just fundamentally flawed. It operates under this low standard of procedural prudence, it fails to protect participants in that critical risk zone, and it mistakenly prioritizes risk capacity over personalized risk tolerance.
A triple failure, really.
The necessary shift toward safety, proven by that U-shaped glide path philosophy, low risk at retirement, gradually re-risking later, is both academically necessary and fiscally prudent for anyone planning their single, non-repeatable life.
The retirement investing world is changing. It has to, driven by the sheer scale of the risk and the mounting legal exposure. Personalization, backed by scientific rigor, is the key to achieving real safety. And Soteria offers that missing structural science.
The science of lifetime investing paths.
Combined with the necessary personalization and the safe landing glide pathy framework, protecting assets in both corporate retirement plans and individual IRAs, Soteria is taking the lead in this essential movement.
We strongly encourage financial advisors to recognize this urgent need for substantive prudence and to embrace this breakthrough in their practice immediately.
For advisors to retirement plans, this is your opportunity to bring Soteria as a breakthrough QDIA solution. It allows you to offer a master customized TDF, giving the plan control over risk levels and correcting that fundamental, legally vulnerable, one-size-fits-all flaw.
And for advisors to individuals, use the separation principle to bring the science of safer, personalized paths to your clients. By providing the optimal structural investment model, the validated safer glide path, you can better serve them across all their accounts, applying the same high standard of care to their company plans and their IRAs.
Think about the immense human toll of the 2008 crash, the profound disruption, the economic depression, the emotional and physical calamities suffered by those who needlessly lost a third of their life savings. Now consider that the next crash will occur with $4 trillion in assets, with 75 million baby boomers sitting directly in the unforgiving retirement risk zone. The question is no longer if fiduciaries will be challenged on the basis of substantive imprudence for choosing these excessively risky TDFs, but when that crisis hits, and who among the advising community will be prepared with a solution that meets the higher, scientifically demanded standard of care.